Welcome to the last talk to be given by Eugene Tan of University of Toronto. Eugene, you have 1 hour.
All right, let me just share my slides. Okay, so thanks for having me on this program. So this paper is joined with Andrea Lanteri at Duke University and Pamela Medina, my colleague at Toronto. All right, let's see. Okay, so let's get out of the way. So the motivation for our paper is going to be as follows. Okay, so there's a large literature in trade that sort of looks at the effects of trade liberalization on sort of gains in the long run for productivity and say welfare. Okay, and the idea typically is that these kind of trade liberalization is going to lead to some kind of reallocation of factors or selection, and that leads to long run gains from trade. So that said, there's kind of pervasive evidence from sort of the firm dynamics perspective that there are sort of frictions to capital reallocation. And these frictions tend to have the largest bite, not in the long run, but in the short run. It's basically, there's difficulty in reallocation of factors that's going to essentially lower the gains to trade, at least for the short and medium term. So the big picture question that we have is, what are the short and medium run effects of import competition shock on firm investment dynamics, as well as aggregate productivity, when there is these kinds of capital reallocation frictions. So in this paper, to answer this question, we're gonna basically use Peru as our case study, where we're going to look at the effect of China's import competition on Peruvian manufacturing. And we're going to approach this topic from two perspectives. So we're going to look at the data first on Peru, and we're going to present two sets of facts that, at face value look a bit disjointed. So we're going to present facts on sort of firm facts, firm dynamics facts, to basically argue that sort of at least capital investment irreversibility is a big deal in Peru. Then we're going to look at what we call trade shock facts, okay, which is basically looking at what is the effects of import competition on capital reallocation. And our big idea here is that when we look at this dimension, we see that in the short run, at least, increased import competition appears to increase measured capital misallocation, and greater investment in action and greater exit, where sort of the composition really matters. Okay, so when I say composition, I'll talk more about this as we go into detail in the paper. So these are the facts. They look a bit disjointed. So we try to sort of look at them jointly in a quantitative GE model to sort of interpret what they mean. So our model has basically as a key feature capital irreversibility, and we're going to simulate a trade shock and then sort of trace the GE transitional dynamics in response to this trade shock. So what we find in our, at least in our model, which does match.
Hi Eugene. Hi Eugene. Can I have a big picture question?
Yeah.
So this paper by David and Venki, right? So they look at China, right? So they find that the capital wedges, it's adjustment cost doesn't account for it. So transient dynamics is not that important. It's more the fixed effects or size dependent policies that's much more important than this adjustment cost story. So did you look at so did you try to do what they did, and are the Peru's data different, so that the adjustment cost or transient dynamic play a much bigger role for the misallocation?
Yeah, so the Dave Venki paper in the AER, they don't actually look at transitional dynamics. What they have is sort of a stationary equilibrium, and they're kind of trying to sort of decompose sort of in the stationary equilibrium how much of misallocation can be accounted for by sort of physical adjustment frictions, how much by sort of these kinds of firm-specific fixed effects, what they call the firm-specific wedges. So that's not really what we're doing here. So we're not saying sort of that there's a lot of misallocation, and a lot of misallocation is coming from capital irreversibility. In fact, when we go to the actual quantitative model, you're going to see that sort of in terms of the actual levels is not that big. What we're going to really say is that these kinds of capital adjustment frictions affect what you're going to see in maybe say national accounting when you try to measure the gains from trade. And the sort of maybe like a bit more surprising finding, not the first one, but the second one, is that if you look at aggregate TFP, you're actually going to find a short run TFP loss. So in the long run, this gains, this trade shock does lead to positive gains from trade. So aggregate TFP does go up. But
Right.
in the short run, yeah, it actually generates misallocation.
Right, I understand, but you do control for some other capital wedges in the model.
Not in our model. No, we don't account for capital wedges.
Right. So that I'm wondering whether if in the presence of those more permanent wedges that were going to survive in the stationary equilibrium, how does that going to affect your transient dynamic calculation?
So in this context, it wouldn't, because these are basically long run distortions on the average, on the productivity of the firm. So at least for the for the investment policy function, which is what essentially boils down to when we look at TFP losses, it's not going to distort the response of these firms because they're permanent fixed effects. Now there is another component of their model which says that these fixed effects are not fixed; they are correlated with also your productivity
size, right?
AR1. Yeah. So in that sense, we haven't really thought about that as much in this specific context. And no, it's not that we don't think that they're important. We're kind of limited by our data, which is that as you're going to see basically our panel, we have a long panel, but actually there's a very high attrition essentially. So a lot of times firms just disappear because they either go out of business or they don't pass the census threshold, so we don't see them anymore essentially.
I see.
So it's very hard to sort of get firm fixed effects from very short panels like these in this context.
Okay, all right.
Yeah, but sorry, going back to sort of the big picture result of our at least our modeling exercise is that on the extensive margin, we find that in the short run, the average productivity gain, so like the average productivity of the firm, is about half as the of the long run gain. So there's a very huge compensation effect that comes into play in the short and medium run. And then on the intensive margin, in terms of factor allocation, we actually see short run TFP losses, which are then eventually recovered and then they become long run TFP gains. So long run factor reallocation gains. So that's the big picture here. Okay. So if there are no other questions, I'm going to move on. Okay, so our paper is sort of broadly related to three literature in macro and trade. So as Xiaodong already mentioned, our paper is closely tied to this literature macro on capital misallocation. For instance, the David and Vanke paper in the AR. And then also, of course, we're looking at investment irreversibility. So there's a long literature on this. And partly sort of this is reflecting sort of Andrea and my bias. We look on our research on capital irreversibility in our papers. And then for trade and reallocation, so we're trying to relate to this long literature in trade, thinking about gains from reallocation. And I think our main contribution here is to make a point sort of that, perhaps we should also think about these short run effects to the sense that when you look at sort of trade policy changes, policymakers tend to think about these short run effects more than think about long run effects because you can actually quantify that and see them right away. Okay, so it's kind of the big picture here. Okay, so for the rest of this this talk, so it's going to be divided into sort of what we find the data. I'm going to briefly talk about our model, and then we're going to go into sort of the quantitative analysis using our model. Okay, so data. So we draw from sort of three main data sources. So the first data source I kind of hinted at earlier is this encuesta survey in Peru, which is from 2000 to 2015. And the way that this survey is done is below a certain size threshold, you're kind of a random sample. Above a certain size threshold, you are sort of part of a census, you always see them. And with that in mind, we see about 1,500 firms every year. And we're going to focus on the 6 largest industries, which make up the majority of our observations in the first place. So with this data set, the key sort of thing we see is that we see the balance sheet of the firm, we see employment. And so because of that, we can actually then measure things like firm revenue productivity or sort of the firm marginal revenue per of capital. Okay. Now, sort of one issue of this data set, as I mentioned, is that there's a lot of firm attrition because of the way that the sampling is done. And so we're going to bring in a second data set, which is the firm registry in Peru, which is from 2007 to 2015. The benefit of this data set is that we actually see the legal days of operations of the firm. So we know for a fact whether sort of when the firm disappears from the encuesta, is it because they exited or really just because they are traded? So in this sense, this is going to form the lower bound to our estimates, because a lot of these firms, even when they're legally operational, they're technically zombie firms. They don't really work anymore. So this is the lower bound to our whatever extensive margin that we find. And then if we only use this data set, it becomes sort of the upper bound of what we find for exit. And then the last data set, we are interested in looking at trade shocks. So we're going to bring in data from UN Comtrade. Essentially, our import shock is just Chinese import penetration in Peru at the industry level. For our robustness exercise, we also merge in import from other countries, which we use as instruments for our regressions. So that's kind of the overview of the data set. So, I'm sorry.
So you talk about the upper bound and the lower bound, and that inspires me to think about a related question, and that is like, how important are informal firms in Peru, and how would the informality of operation be affected by trade liberalization?
Right. So so my understanding of Peru, my co-author Pamela is Peruvian, is that it is a very large sector. But these firms, because we're thinking about capital misallocation more than sort of other kinds of misallocation, they don't use much capital, so they don't account for a lot of the national capital stock. So in that context, they're probably not as important for what we're interested in, which is capital reallocation frictions. Now they are probably important for like labor reallocation, which is a big thing in trade right now. But for our question for capital, I think it might be less important.
Got you. And your main data set only covers the medium and large firms, I guess, right? Because they're only like 1,500. Yeah. And then you are trying to use the registry data sets to provide a more complete or comprehensive coverage of the data.
Yes, especially because we're interested in looking at the exit dimension. And so a lot of these small and medium firms, they're not always there, even though they're actually alive. So we don't want to sort of overestimate the impact of the trade shock on exit, essentially.
Okay, good. Thank you.
Yeah, thank you. Okay, so going on to our measurement framework. So I've broken out my talk in sort of measurement for the firm and measurement for the trade shock. So for the firm, we're going to basically adopt the standard macro idea that there's going to be a physical Cobb-Douglas production function. We're going to have CS demand for a final good. And so that gives us a value-added production function like this, from which we can then just back out revenue productivity as well as the marginal revenue product of capital. Now, because of our assumption on that it's Cobb-Douglas, so the MRPK is just a fixed proportion of ARPK, of the average revenue product of capital. It's very straightforward here. Now, for the trade shock, what we actually do is we're going to, like we said, we have the UN Comtrade data. We're going to actually construct import penetration as the share of Chinese imports relative to world imports in Peru. And so what we're going to use this measure as our measure of import penetration, which actually strongly correlates with actual import penetration. Now, our baseline results actually come from this version, where because we want to sort of simulate, at least construct trade shocks. So we're going to run regressions on deviations from trends. Okay, so we're going to interpret these deviations from trends as the shocks. And then in general, our results are also robust to instrumentation via sort of neighboring countries, as well as via countries that are not in South America. But for today, I'm going to present my baseline results using the deviations or trends. Okay. So I'm going to present with the sort of the effects on firm dynamics first, before moving on to the trade shocks. So fact number one is that so MRPK, so there's high persistence of MRPK across the distribution, but there's much higher persistence of low MRPK than high MRPK. So what we did actually is that we sort of every year we bin and rank firms into terciles of the MRPK, and then we estimate the transition probabilities going from, say, first tercile to first tercile. So if you first look across the distribution along the diagonal, we find that they're all larger than 33%, saying that there's a lot of persistence in your ranks. That said, if you look at the first tercile, you have 82% chance of staying in the first tercile. But if you're in the third tercile, you have a 77% probability of staying in the third tercile, suggesting that there's higher persistence of low MRPK than high MRPK. Now, why do we do this? Why am I showing you this fact? So if you think about a standard firm dynamics model with frictionless capital adjustment, okay, the model always predicts that there's going to be no persistence at all across the distribution, okay? And the idea is that, if you wake up today, you get hit by a bad shock, right? You have low MRPK. The first reaction you're going to do is you're going to sell your capital. So you're going to mean revert back to the median, right? Likewise, if you have high MRPK, you got a good shock. Then what you're going to do is you're going to invest, you're going to expand. That's going to reduce your returns to capital. So you're going to revert back to the mean. So you're going to see mean reversion. And not in this paper, but in my other paper, I kind of showed that this is just a theoretical prediction of the standard model.
Can I offer a comment and ask a question, Eugene?
Yeah, sure. Yeah, go for it.
So one of the ways in which Key and Share and Klino notion of a misallocation is wrong is that because it does, it's incompatible with asset pricing model. Asset pricing model tells us that mrpk should be systematically different across firm as a function of risk. So for example, you think about asset pricing model, different firms should have different beta, and firm with different beta would have different mrpk. And your current, what you just said about this table can simply be restated that betas tend to be stable. If firm A has higher beta than firm B, on average over different times, you always find firm A to have higher beta than firm B. So there will be another. So in other words, this thing, the table you show is entirely consistent with what asset pricing model view of the world would be.
Right.
So just offer so therefore so I mean this so that will not be interpreted as misallocation always revert back to the mean, but rather that just confirms that there are systematic deviations of mrpk across firms or industries that have nothing to do with misallocation.
Okay, so so I have to think a bit more about what this context implies, but so my understanding is that if to the extent that there's some kind of systematic risk involved at the firm level, right? It's true that that's going to be reflected in your beta, and so that's going to generate some kind of persistence mrpk. But it's in a competitive framework, it doesn't really change the effect that there's going to be some kind of reduced persistence, right? So there's going to be persistent. They're gonna have there's going to be some kind of correlation in your returns to capital across time, but it's not going to be asymmetric per se, unless there's some kind of factor involved that is driving this kind of persistence. So in a sense, what I'm going to tell you might actually sort of agree with what you're saying, because what we're going to have is basically say that essentially there's some kind of like if you think of the value premium where there's some kind of capital irreversibility that is going to cause these very low mrpk firms that instead of selling, they hold on to too much capital, right? So we're not saying that there is sort of systematic misallocation, which is what the Share and Klino paper would have said, but rather we are saying that, hey, in this alternative world where there is no capital misallocation, there's no different wedges, we can still sort of rationalize some of this persistence via the fact that there is some kind of capital frictions and make it hard for them to mean revert, if sort of that makes sense. Or maybe.
That's okay, but I mean, I was from the from the asset pricing viewpoint, right. They don't mean revert because this the deviation from common common MI, there's no common MIPK basically. MIPK are proportional to risk features. If risk features persist, you will get these patterns. So I think it does not require your interpretation to have the pattern.
Okay, so like different
pattern you presented here, basically.
Okay, I can see that. Yeah. Okay. I guess maybe let me think a little bit more about it. Sorry, it's a bit late in Toronto right now, so I'm like my mind is like not very clear. But let me think about it. But thank you so much for the comment. Yeah. So
how robust is this fact anyway? Because you kept talking about the diagonal, but I see a U-shaped relationship mostly, right? So
the U-shape, yeah.
I mean, you don't have a monotonic relationship that smaller firms tend to have higher persistence than the larger firms. I mean, if anything, if the facts are robust, then what needs to be explained is why the medium-sized firms tend to have a lowest persistency.
Right. So actually, this when you estimate yeah, so this is quite robust actually. So when you estimate this kind of matrix, you have something called the floor and ceiling effect that basically overstates immobility for the first and the third, which is why you see the U shape. If you've been into quintiles, you're going to see the same thing again, which is that the tail ends are going to be higher than the middle, which is why we don't really make this point about high persistence per se. What we're kind of saying is that, hey, if you think about the frictionless model, right, people are always going to adjust appropriately so that there is no persistence. Now we see some persistence, which is interesting and kind of a bit consistent with Shari and Clino, but that's kind of a different story. But what is kind of more interesting for us is that there's higher persistence for low MRPK firms relative to high MRPK firms. Now, in this literature, at least for the macro from dynamics literature, there's been a big focus on sort of capital investment frictions, like financial frictions. Now, that kind of frictions typically what they mean is that you're going to it's going to make it hard for you to capitalize your firm. So that's going to generate persistence in high MRPK. And what we're looking at with this picture is that, hey, it seems like maybe we want to think about a different kind of friction, which is this investment friction, frictions that make you not want to downsize in this context. Right.
Okay.
Yeah. So again, this is not a picture that sort of says that one framework is correct on another, but more of like a suggestive picture saying that, hey, this suggests that maybe we should think about capital like selling frictions and just take it a bit more seriously in this context of sort of trade shocks. Now, when we go to the model, we're not going to actually use this matrix for our calibration. We're going to use more standard firm dynamics friction moments, and then we're going to assess whether those moments are consistent with this picture. And then I'm going to show you a bit more about that later. So that's how.
Eugene, just one a bit confused. Yeah. So the low MRPK. So if I imagine low MRPK firms are the ones who are unconstrained, and so therefore the MRPK should just equal to the market interest rate. So as long as the market interest rate is persistent, then they should be persistent, and there's nothing about inefficiency of that. It's not necessarily they're not selling the capital, but they are just at the frictionless level.
Right. So we are taking the stance that sort of capital is a quasi-fixed factor. So you have to buy capital in advance. You cannot see productivity tomorrow. So in that kind of framework, actually, everyone can face the same interest rates, but if you're unconstrained, you're still going to be hit by a shock tomorrow, and that's going to drive drive away the persistence. So essentially, right. you can sort of show like in a frictionless world, right? MRPK is equal to sort of a
right.
function
Depend on how big the shock variance is. Yeah.
Yeah. Exactly. Yeah.
Yeah.
Okay. So okay. Yeah. So let me just quickly move on a bit more, I guess, in the interest of time. So one thing I wanted to sort of maybe a more direct evidence that maybe is a bit more convincing is that what we did was we looked at the distribution of capital growth rates for the low MRPK guys and the high MRPK guys. And our argument is that, these guys are low MRPK because they're not selling, right? So, if it was sort of an argument that people face different interest rates, and so they're targeting different MRPKs, then what should be that the distribution of the capital growth rates should be the same, right? And that's not what we see. We see is that actually the first tercile guys, there's this huge spike at zero. A lot of them are basically in their inaction region. Whereas the high MRPK guys, you see this very long right tail, suggesting these are the guys, they are actually investing. Maybe they're not investing as much as they should, but they are investing. So, which for us at least seems like this low MRPK immobility is basically driven by a lot of lack of this investment. And maybe not entirely, but
sorry, Eugene. So just follow up the question. Maybe it's related to what Changjing was suggesting. So again, if you think about low MRPK are the ones who are having a larger exposure to the market risk,
right?
Lower exposure to market risk.
Lower,
right? So
that low interest rates,
have a lower equity premium, right? So therefore the MRPK is low, and so therefore because they have less shock, so you will see a higher persistence.
Well, so I think
so could be systematically different between the low and high, right? So high ones
this is going to shocks. So yeah, this is going to go into like a lot of assumptions on what exactly is the shock process they face, right? So suppose everything is the same, the only difference is the volatility. Then now what you should be seeing is one has lower variance and the other one has higher variance. But there's no reason why they actually have they have different skewness, they have different kurtosis, right? Now we can also argue that the high MRPK guys also face some kind of completely different productivity process, but it's a bit hard to sort of challenge that or estimate that given the data that we have, essentially. But I think that was an interesting thing to think about, I guess. Yeah. But so thanks for the comment again. Sorry, like I've been awake for a long time, so I'm a bit tired right now. But thank you so much, guys, for the comment. So if I'm not being super clear, feel free to email me or something after the conference. Okay, so fact number 2 is that capital predicts survival. So essentially what we did was we ran a regression of exit, or actually survival, on productivity, log productivity, and log capital stock, controlling for a bunch of other variables. And what we see is that conditional on productivity, firms with higher levels of capital tend to be less likely to exit. So what I have plotted here is actually a heat map of survival probabilities. So if you go into basically the darker colors, is a higher probability of survival. So just imagine if you draw a horizontal line across here, given some productivity levels, as your capital stock increases, you're more likely to stay in business. Now, why do we sort of show this picture? And the reason is because if you take a sort of standard sort of Oppenheim type model, okay, now that model is going to predict basically that the only sort of relevant state variable for exit or survival is productivity. And so that means that once you control our productivity, size doesn't matter. So this shows that actually size really does matter for the firm exit. And so we're going to basically argue that part of this comes from the fact that capital is irreversible. So large firms, they have an option value of staying in business. So they don't want to sell even when they're hit by bad shocks. It's kind of our basic economic sort of idea here behind this picture. Okay, so this is facts on sort of firm investment dynamics. We have a bunch of robustness checks, but I kind of think that I might be running out of time here. So because I have a bunch of other facts to show you guys. So if I can talk more about this, but I think that our results are pretty robust to a lot of the checks we have done. Are there any questions? Okay, so now that was the firm dynamics facts. Okay, so hopefully I know at least you're like 10% convinced that there's some capital irreversibility here. Now we're going to go into the trade shock facts, and there are 3 things I wanted to show you today. So the fact number 1 is that in response to a trade shock, there's going to be a short-run increase in firm inaction, and this increase in firm inaction is entirely driven by these firms that used to be doing positive investment, and now they're going into the inaction region. So in the table here, what I've done is basically we run a regression of on the first column inaction, which we define as sort of average firm investment rates within a certain range. On the China shock, the trade shock, and you can see basically that the more exposed you are to the trade shock, the less likely you are to do anything, the more likely you are to be in the inaction region. When we split the regression into firms that are doing positive investment and firms that are doing negative investment, you see that this effect is coming through entirely because when firms that used to be doing positive investment, they're hit by this trade shock, they now stop doing the positive investment. In contrast, there's very little action on the negative disinvestment front. So it seems that there's very little sort of capital reallocation going on, at least for investment. Okay, so this is fact number 1. Now, I'm going to show you fact number 2, which is actually quite consistent with what we see in fact number 1. Okay, so fact number 2, basically what we have is we see that we compute the dispersion of MRPK at the industry level, and then we run what is basically a regression of the change in MRPK dispersion on the trade shock. And what we see is that there's going to be a short-run increase in MRPK dispersion as a result of the trade shock. Okay, So what we have plotted here is essentially an impulse response, accumulative impulse response function. Okay, so year one is when the trade shock hits, and you see that there is no impact. This is actually going to be consistent with the idea that capital is a quasi-fixed factor, and so that you simply cannot capital changes simply cannot respond to the trade shock the year that it shows up. In the 1 year, however, with a lag, you see that we're going to see that mrpk dispersion actually increases, suggesting that there is some amount of increased capital misallocation. Okay, and this is actually quite consistent with fact number 1, which says that in response to the trade shock, a lot of firms go into the inaction region. Okay, in the sense that when you have more firms in their inaction zones, they're going to be distorted further away from the optimal firm size, and so that generates capital misallocation. Now these are short-run effects. So in the 3rd year, they disappear, and then we're going to have a model that essentially is going to capture this kind of short-run changes. So that's fact number 2. And then the last fact is on the extensive margin on selection. Okay, so unsurprisingly, what we find is that in response to the trade shock, firms are going to be more likely to exit. What is a bit more surprising is that there's going to be a composition effect. Okay, so what we're going to see is that this exit is going to come from both low productivity firms, that kind of large but low productivity firms, which is consistent with the standard Hoppenheim or Mellitz type model. But we are also going to see exit by high productivity firms who are small. And this is not consistent with sort of the standard sort of Hoppenheim or Mellitz type framework, where you should only see a single threshold. And so, you're going to have pure selection purely on productivity. You're not going to see high productivity firms exit. Turns out this composition effect is going to matter when we go into the model. Okay, so those are our 3 facts about the trade shocks. So are there any questions?
Eugene, do you have data on, say, energy used, to proxy capital utilization?
Yeah, actually we do. So that's one of the things that I actually skipped. So, and that's a really good question. So what we did was we use energy and also other intermediates as proxies for utilization. And the idea is that, okay, we have capital irreversibility, right? When we measure mrpk using capital, but we're not really measuring the true utilization rate of this capital stock. So the hypothesis is that once we correct for utilization, this persistence asymmetry should go away. And I guess I don't have the table in this slides here, but essentially the asymmetry goes away once you sort of correct for utilization. So suggesting that the factor of production is in the firm, but it's not being used by the firm essentially. Yeah. So yeah, thank you. Right. So yeah, so that was the facts on firm dynamics and trade shocks. And so just notice a summary of the evidence. Facts about firm dynamics is to lay the ground for capital irreversibility. Facts about trade shock is, as I'm going to show you, is that actually these facts are very consistent with a model that includes capital irreversibility. And so unsurprisingly, we're going to write down a model that's going to have investment irreversibility. So what is our model here? We're going to have a standard Hoppenheim type model with representative household with log linear preferences. So log over consumption, linear utility function, linear utility over labor. They're going to have a C as demand structure over the final consumption goods. And so what we have is essentially that that this M here is domestic consumption, domestic production. And then when the economy is in autarky, so when they're not importing, this is what they actually buy. And then when we have a trade shock, we're basically going to increase the number of varieties available to the household. The MF is the amount of foreign varieties. So now the number of varieties in the economy increases exogenously. That's our trade shock. So on the firm dynamic side, we are going to have heterogeneous manufacturing firms. So they're going to be heterogeneous along many dimensions. It's going to be idiosyncratic persistent productivity shocks, idiosyncratic fixed continuation shocks, idiosyncratic fixed entry costs. So that means that we are going to have endogenous entry and exit in our model. Okay, but the key sort of difference in our model relative to a standard trade model is that we're going to have capital investment irreversibility. And then we're going to close the model by having an export sector that produces output using labor, and that allows us to maintain a balanced trade assumption. Okay, so that was the big picture here. And So just to put some equations to mind, okay, so like our measurement framework, we're going to have a Cobb-Douglas physical production function. Capital accumulation is standard, and the way that we measure model irreversibility is that if you're buying capital, you pay a cost Q, and then if you're selling capital, you get a little q that is less than big Q. And so we're going to calibrate this wedge to the data. And then if you exit, okay, subject to some continuation cost. If you exit, you're actually going to face a second dimension of irreversibility, which is that you're going to recover a scrap value that is a fraction of the resale value of the asset. Okay, so it's going to be even, if you exit, you're going to get even less money back, essentially. Okay, so with that in mind, now we can just state, the problem is relatively standard. Essentially, if the incumbent wants to continue in business, they decide on how much investment to buy. They pay the continuation cost, taking into account of the SDF of the representative household, which is a pretty standard investment problem. And then if they exit, they just get back the scrap value of the asset. And so if they want to, whether they stay in business or not, it's just the upper envelope of the continuation value versus the exit value. Okay. And then for entrants, they're gonna very similar to the incumbents, they're gonna draw an entry cost, and then they draw an initial condition like in Oppenheim, and then they're gonna decide if they want to pay the entry cost or not. And then if they do pay the entry cost, then they're going to invest in capital, again, taking into account of sort of the house's SDF. So something that we want to emphasize is that, this is a general equilibrium structure. So the interest, in the steady state, it doesn't matter as much, but during the transitional path, this is going to matter for how the firm investment behavior changes relative to the trade shock. Okay, so equilibrium definition is pretty standard. Okay, so this is just saying that household and firm decision rules are optimal, and then we're going to basically clear the labor market, clear the market for each variety, and then there's going to be balanced trade. That's kind of what this says here. Okay, so moving on sort of to our sort of main results. Okay, so we calibrate our model to the data. Okay, so the first two parameters are standard, and then the last are, again, they're very standard, coming sort of straight from the literature. One key point we want to point out is that when we calibrate the extent of irreversibility, we target the frequency of negative investment. And so, like I mentioned earlier, we don't use the mrpk persistence as a way to discipline our model. Rather, we are using that as a way as a form of external validation for our model. Okay, so this is what we have in our model for mrpk mobility. So again, like in the data, we bin them into terciles, and then we estimate the transition probabilities. And you can see this sort of like, if you're in the first tercile, there's a 62% probability of staying in the first tercile, and if you're in the third tercile, there's a 50% probability of you staying in the third tercile. So again, there is persistence in mrpk. There's higher persistence in the first tercile relative to the third tercile. Now we don't get the level of the persistent correct, which is not surprising. As earlier, as some of you in the audience have already mentioned, there are many reasons why there's persistence in mrpk, and capital frictions is just one of them. You can have heterogeneous heterogeneous interest rates. You can have fixed effects that can also drive differences like this. So it's not surprising that we don't capture all the persistence of mrpk. Now, what we want to reference is the frictionless model, where, as I mentioned, in this world, there is no persistence. Okay, so in this kind of the intuition earlier that get hit by a good shock, you expand. You get hit by a bad shock, you sell. So there's no persistence in the returns to capital. Okay. So that was about the mrpk mobility. Then we also looked at sort of the various extensive margins of adjustment that we have in this paper. So we have an extensive margin, which is just exit, right? And this is the downward sloping threshold, which is consistent sort of with what we saw in the data, which is that the exit depends on both productivity and capital. So actually, this is something that we explicitly match with our model, basically the slope. Then, of course, in our model, we're also going to have, unsurprisingly, an SS band. So the dashed lines are the SS bands. So And this is something that's going to be relevant for us when we sort of take our model to the trade shock extension. Now, in contrast, if you're a frictionless model, like I said, selection is going to be purely on productivity. There's no selection on capital. And then at the same time, obviously there's no SS bands to speak of because there's just no non-convex adjustment, no non-convex adjustment cost. Okay, that was just the model predictions. Now let's talk about the trade shock. Okay, so how do we model the trade shock? So in our model, the only parameter that we can play with in terms is basically introducing a one-time unexpected increase and permanent increase to the mass of foreign varieties. Okay, so what that happens then is that unlike is that import penetration is not going to shoot up right away because there are general equilibrium forces in place. Instead, import penetration is going to gradually rise over time. So it takes about 15 years for this to converge to the new steady state. Okay, so what we actually do is we calibrate this MF, all right, such that the long run steady state for import penetration is consistent with the data in 2015. And then we introduce MF as a shock at the first year in 2000. And you see that it basically converges in 15 years. Okay, so that's our trade shock. Now, in terms of the macro dynamics, okay, what the trade shock is going to do to the economy is that you have this sudden influx of foreign production, and capital is a quasi-fixed factor, right? They cannot adjust right away, so price is going to tank in the first period, which is what happens here. So prices overshoot in the first period, and then they eventually recover, but the long run average is still going to be lower, exactly because there's just more variety in the economy now. There's tighter competition. Now, this is going to be bad news for domestic manufacturing firms, right? Because they're getting lower prices. So that means that they're going to try to downsize, or they're going to try to exit as much as possible. Now, unlike certain models without resale frictions, okay, these firms are going to downsize relatively slower. Okay, so they're going to sell, they're going to exit, and this is for capital, but it's not going to sort of jump to the new steady state because it takes time for them to actually sell the asset. Okay. Now, likewise, we don't have any sort of labor adjustment frictions, which is a bit different from, I think, the trade literature, which has looked at a lot about labor reallocation frictions. But we do have a relatively slow labor adjustment. And part of that is because the capital stock is a slow-moving variable. So your capital stock decreases slowly, then the amount of labor hiring is also going to move proportionally, and so it's also relatively slower. So this is for labor, and this is just the number of firms that are active in the economy. Okay. So now I'm going to sort of show you how our model framework, okay, then sort of helps explain some of the trade shock results that we saw. So the first this figure I'm showing you is essentially the SS bands at time 0 in the initial steady state and at time 1 in response to the trade shock. Okay, so the solid line is the SS band in the initial steady state, and the dashed line is the SS band during the trade shock. And what you see first off is that the inaction band widens, consistent with what we saw in the data, which is that there are more firms doing inaction. The second thing we see is that this widening of the inaction band is basically driven by the movements in the investment arm. Okay, so you're less likely to do positive investment. In contrast, if you look at the disinvestment arm, this is almost on top of each other. There's almost no change. So all the increase in action is because these guys that used to do positive investment now choose to not do positive investment. Is there a question? All right, so I think this is kind of consistent with what we saw in the regressions that we looked at earlier. And what does this translate to the macroeconomy?
Eugene, do you think you can wrap up in 1 minute?
Oh, shoot. Okay,
sorry, it's my mistake. You still have 15 minutes. Sorry for the shot.
Oh, sorry, how much? So I have 15 minutes or one minute? 15 minutes, okay, sorry. I'm like, it's really late here, so I'm a bit losing track of time, to be honest. But I woke up at 6 o'clock in the morning, so this is a bit confusing for me. Okay, yeah, so let me just, yeah, no problem. Yeah. So Okay, so that was what this SS bands that I was showing you. So how does that map into sort of the macro outcomes? Remember, I showed you fact 2, which is that short-run MRPK increases in response to the trade shock. And on the left panel, we plot the dispersion of MRPK over time in response to the trade shock. And kind of the solid line here is the baseline, and exactly what you saw in the data. Okay, year 1, there's no response because capital is quasi-fixed. It cannot respond to the trade shock. Year 2, however, because of this change in the SS bands, with more firms being distorted away from the optimal capital choice, you start seeing an increase in the dispersion of MRPK. In turn, and then over time, okay, all these firms, they start seeing what's going to happen, right? And then they start either downsizing or adjusting as appropriate, and then the dispersion of MRPK declines. Again, very similar to what we saw in the data. Now, in contrast, if we look at the frictionless model, actually you don't see this kind of results. They get hit by the trade shock, all the bad guys sell their capital, right? And then they just, the dispersion falls by a little bit. Now, this result is sort of translated for TFP as a short-run TFP loss. So the solid blue line here is basically TFP losses in the short run, and then in the long run, again, firms that want to sell their capital eventually sell their capital. Firms that want to exit eventually exit, and so eventually aggregate TFP increases in the long run. But you do see these short run losses. In contrast, if you look at the frictionless model, you see that basically there's almost just right away you see these gains from trade, basically gains from factor reallocation realized almost instantaneously. Okay, so that was on the intensive margin, which is capital, how you reallocate capital. Now we look at the extensive margin, which is to say, how does these kind of selection effect affect also the gains from trade? And so remember, I told you that in response to the trade shock, low productivity firms exit, but high productivity small firms also exit. And our model has a similar flavor. So the solid line here is the at time 0 baseline, and then the dashed blue line here is the time 1 baseline. Okay, so the selection margin shifts out. So you have these low productivity guys that kicked out, but you also have high productivity small guys that kicked out. Now, in contrast, if you go to the frictionless model, which is the red lines here, you see that the selection margin just shifts up like this. So you get a uniformly you kick out from the bottom all of the crappiest guys in the economy. You will never see exit of high productivity guys. So there's no competition effect. Now, what that means for our sort of more macro predictions is that the average productivity gains as a result of the trade shock, at least for the baseline here, is about half that in the short run relative to the long run. In contrast, if we take sort of an off-the-shelf Hohenheim or Mannet's model, and you sort of subject the economy to a trade shock, you see that basically all of the gains are realized right away in the first period, because you have this effect that you just simply kick out the worst guys. You don't have this competition effect where you're kicking out bad guys, but you're also kicking out good guys. Okay, so that was kind of our main results. Now, we do actually try to do some robustness check in our paper. So one of the things that in macro at least, there's a big literature on physical adjustment costs that goes beyond capital resale. Right? There's quadratic capital adjustment costs, there's fixed costs, and so on and so forth. So what we have done actually is that we have recalibrated our entire model with all these parameters, including additional investment targets that are standard to the macro literature. And we find that our estimates of irreversibility is robust to these extensions, suggesting that at least for Peru, capital resale frictions might be a big deal for them. What we find then when we subject that alternative economy to the same trade shock is that the effects are very similar. In particular, the sort of short-run losses are even larger than in our baseline model when we only account for capital irreversibility. Okay. Now, another robustness check we have done is that actually in our model, to account for certain features of the extensive margin, we have allowed the fixed cost distribution that firms draw from to depend on the productivity of the firm itself. In part, we have this assumption in our paper. It sort of reflects the idea that what Xiaodong sort of mentioned earlier, which is that some of these firm distortions are actually correlated with their productivity. Okay, so this is kind of what we have in our model, but it's a bit weird because it's not really that standard. So what we have done in our robustness check is we have shut down this channel, and what we find is that we cannot match the extensive margin calibration as well, but at least for the trade shock we get the same results. Okay, so all these basically suggesting that our baseline model at least is very parsimonious. It's designed to capture key aspects of the firm dynamics data, and seems to get pretty robust results for the trade shock. Okay. So this, just to conclude, I think I guess I went by a little faster because I sort of wasn't sure what time it was, to be honest. But the big conclusion is that capital reallocation frictions, they matter, they're costly, but their biggest bite is not in the long run. Okay, in the long run, if you care about all you care about in the long run, it doesn't matter. But it has a huge bite in the short and medium run. Okay, and so if you care about the short and medium run effects of trade shocks, then at least we think that you should at least account for some element of capital reallocation frictions. And the two big picture thing, I spoke really fast, so if you forget everything I said, right? The two things that I'm hoping everyone takes away from this talk is that productivity gains from trade come gradually over time, in part because there's difficulty in reallocating capital from one firm to another. And also there's a huge composition effect when you look at the extensive margin. And then this can actually lead to short run, at least through the lens of our model, it can lead to short run TFP losses, which is in the short run. In the long run, you still see TFP gains. And that's the story of the paper here. So if there are any questions, feel free to chime in and so on.
Eugene.
Yep.
It's equally late for me here on the East Coast,
Yeah,
but I'm gonna try to sound coherent. Just as a, it's a really nice piece of work, but just as a big picture takeaway, am I right to say that this means that it's particularly costly to be in a situation where, there's a lot of capital that's misallocated towards big firms? So I'm thinking, for example, I can understand why you use Peru. The data is very clean for you to use it, but what if we think about, say, the situation of China, where we might believe that there's a lot of misallocation of capital towards large state-owned enterprise or medium to large state-owned enterprises, right? So
yeah,
it's that capital misallocation in that kind of situation is particularly costly, because to reverse that or reallocate that, you have to run up against some of these capital reallocation frictions, right?
Right. Yes. I mean, like this is a paper that's very focused on a very unique economic environment, Peru, that is very different from China. But in the context of, if you think of there's some kind of mismanaged policy that is directing financial capital towards these firms, and then the financial capital has become transformed into physical capital, then it's true that to reverse the mistakes made by, say, policymakers is going to be very hard. And I think from a real world perspective, you can imagine, right? You build a factory, turns out that this is a dud. You cannot convert the factory back into money again in the next year. It's going to take a while for you to basically sort of turn this factory into something that is useful in a different industry. So yeah, in that context, it's true.
I guess it's related, and that after the financial crisis, after the big stimulus, and there was this a lot of overcapacity, right? That was a question about that, and they call about zombie firms. That's it's very much related to this. So I guess the literature emphasizes a lot about the entry margin, of the lack of entry of productive small firms, but I guess you emphasize about exit margin. I think
yes,
which
it's a bit worse here.
People haven't pay much attention on that. I think, but that's it's relevant margin.
Yes, it's a bit worse here, right? Because you have these low productivity, high capital firms to stay in business, but then you also kick out the high productivity small guys. So that makes it sort of the short run even worse off in that context.
Yeah.
Okay, if there are no further questions, should we close the section 5 minutes earlier? But we will keep the Zoom meeting on, and you can continue to interact with Eugene. And thanks very much for your attendance and participation in the first section. The second section will be on tomorrow. Okay, see you.
Thanks, Polly.
Thanks.
Thanks.